Hey, what's up, legends? It's your favorite stock whisperer back at it, the one who spots megatrends before they hit the headlines. Now listen, today's not your usual, this stock popped 300% overnight kind of episode. Now we're going deeper into the core of what's powering the next decade of energy and infrastructure. We're talking nuclear energy, grid build-outs, and yeah, even AI's obsession with electricity. Wild combo? Maybe. But trust me, the connection here is insane, and the money's already moving. Nuclear's making a comeback after being the industry's forgotten stepchild for years. I'm talking SMRs, uranium demand spiking, and some heavy geopolitical tailwinds. Meanwhile, our power grids, they're getting a full-body makeover. Because guess what? You can't run your AI empire if the lights keep flickering. And here's where it gets interesting. AI's power hunger? It's real. But not in the doomsday, it'll crash the grid way you're hearing about. Nope, there's more nuance and more opportunity. Quick ground rules before we cook. I'm not your financial advisor. I'm your financial instigator. I bring the heat, you manage your risk. Deal? Deal. All right. Deep breath. So in this series, we're going to break it all down. Nuclear's rise, the grid's billion-dollar glow-up, the truth about AI-driven energy demand, and of course, who's going to win from all of this. By the end, you'll know which sectors to watch, which companies are cashing in, and where the smart capital is headed. Ready? Let's power up. All right, let's roll right into it. Next up, the nuclear energy landscape, revival, SMRs, and regional dynamics. We're about to dive into one of the most misunderstood comeback stories in the market. Buckle up. Here's how the stock whisperer breaks it down. Let me ask you something. When's the last time you heard someone get excited about nuclear power? Exactly. For decades, nuclear's been treated like that dusty gym membership you swore you'd use, but never did. Over budget, over-regulated, and totally overshadowed by the cool kids. Solar, wind, and lately AI. But here's the twist nobody saw coming. Nuclear's back on the global stage, and it's playing the long game. In fact, 2025 is set to mark an all-time high in nuclear electricity generation. Yeah, you heard that right. We're not talking theory. We're talking real reactors, real power, and real capital flowing back in. Over 70 gigawatts of new nuclear is under construction right now. That's the most we've seen in 30 years. And it's not just the usual suspects. You've got China and India leading the charge, but also places like Poland, Romania, even Japan doing reactor restarts. Talk about plot twists. Why? Two big reasons. Energy security. Countries don't want to be held hostage by oil prices or foreign gas anymore. Climate goals. You want low-carbon baseload power? Nuclear's the only date to the dance that doesn't flake when the sun sets or the wind dies. Oh, and did I mention that over 40 countries now have nuclear in their energy strategy? Even Belgium is rethinking its phase-out. Belgium! Now here's where it gets spicy. You've probably heard the term SMRs thrown around. That's small modular reactors, and if traditional nuclear is the 1990s Hummer, SMRs are the sleek, factory-built EVs of the energy world. We're talking lower costs, faster builds, and the potential to pop these reactors near industrial sites, remote communities, even data centers. Yep, AI is knocking at the nuclear door. There are 70-plus SMR designs in development worldwide. Real companies, real tech, real timelines. Ontario Power Generation is aiming to bring a 300-megawatt SMR online by 2029. NuScale Power in the U.S. They've already got NRC certification. That's like the FDA for nuclear. X-Energy, TerraPower, backed by none other than Bill Gates, and even Rolls-Royce in the UK are racing to get SMRs deployed by the early 2030s. Oh, and here's the kicker. Tech giants are already sniffing around. The IEA says there's interest for up to 30 gigawatts of SMRs just for data centers. That's not a bet. That's a power play. Now look, SMRs are sexy. But the OGs, the big gigawatt-scale reactors, they're still holding it down. Yeah, they've had some ugly delays. Georgia's Vottle project? Yikes, 7 years late and $30 billion later. But even so, countries like France, the UK, Poland, and India are going all in again. And here in the US, the Biden administration is throwing serious cash, I'm talking $6 billion plus, at keeping existing plants alive and profitable. That's why players like Constellation Energy are suddenly looking like cash flow machines. Government tax credits, rising power prices. It's a good time to own reliable megawatts. Even Japan, after the Fukushima disaster, is back online. 10 reactors restarted. More on the way. The public mood softening. And if you think the West is moving slow, take a look east. China? 24 reactors under construction and plans to double capacity by 2035. Russia's got floating nuclear barges powering remote Arctic towns. India's scaling its own homegrown designs. This is no longer a pipe dream. The International Energy Agency sees nuclear output doubling by 2050, maybe more if countries follow through on their pledges to triple nuclear capacity. But here's the catch, and the opportunity. It'll take $210 billion per year by the 2030s to make that happen. That means massive investment flows, workforce demand, and engineering capacity, all up for grabs. So what are we looking at here? A global nuclear renaissance, yeah, I said it, that's being driven by geopolitics, clean energy targets, and AI's insatiable appetite for 24/7 power. You've got government money flowing, new tech on the launch pad, and supply chains trying to keep up. And for investors, this isn't a trend. It's a multi-decade opportunity. Coming up next, we're diving into the uranium supply crunch. Because you can't run these reactors on hype and hope. Let's talk fuel, baby. All right, let's keep it rolling. And now we're getting into the fuel behind the fire, uranium. Because, hey, all these shiny new reactors, useless without the yellow cake. Let's break it down. Stock whisperer style. Okay, so nuclear's staging a comeback. Awesome. But here's the part nobody's talking about at the dinner table. Where's all the fuel gonna come from? I'm talking about uranium, the lifeblood of nuclear power. And let me tell you right now, this market is heating up fast. The numbers don't lie. Global uranium demand is on track to jump 28% by 2030 and then double again by 2040. Why? Because as new reactors fire up across China, India, Europe, and yep, even the US, everyone's gonna need more enriched uranium. Simple supply and demand, right? Well, not so simple. Short-term supply looks okay. But the long game, yikes. Sure, for now the supply side's keeping pace. Barely. Big producers like Cameco and Kazatomprom ramped back up post-COVID. Mines that were sitting on ice, like MacArthur River in Canada, are finally running again. That's helped cover current demand. But here's the red flag. By the mid-2030-50s, output from existing mines could fall by half if no new supply comes online. Half. And building new uranium mines. Not exactly a weekend project. We're talking 10 to 20 years from exploration to actual production. So if the industry doesn't move now, we're headed straight for a supply crunch. That's when prices go vertical and the players who positioned early, they cash in big. Let's talk price. Uranium spent most of the 2010s in the bargain bin, hovering under $30 a pound. But since 2021, this thing's been on a stealth bull run. As of late 2025, uranium hit $82.63 a pound, a multi-year high. Futures for early 2026 are staying strong too, holding in the low 80s. That's not a fluke. That's a market sniffing out future scarcity. Oh, and get this. It's not just utilities buying. Financial players are loading up. Funds like Sprott Physical Uranium Trust are literally stockpiling the physical stuff, betting this isn't just a trend, it's a long-term shift. And they're not wrong. The DOE, yep, U.S. government, just threw $2.7 billion into developing domestic enrichment capacity. trying to get ahead of the curve for advanced reactors that need HALEU, high-assay, low-enriched uranium. Why? Because Russia is the only one producing HALEU at scale right now. And if you think the West wants to depend on them for energy supply, no. It's not just about digging uranium out of the ground. The whole fuel cycle, from conversion to enrichment to fabrication, is facing serious strain. Conversion facilities were shuttered in the 2000s. Cameco only just reopened its Canadian plant in 2023. Enrichment? Limited outside of Russia. Western capacity needs a serious upgrade. Fabrication? Especially for SMR-specific fuel types. We don't even have the full infrastructure yet. Add in some geopolitical spice, like Kazakhstan shipping uranium through Russia, or the coup in Niger that freaked out French utilities, and suddenly, uranium supply looks a whole lot less stable than people think. So, who stands to win? Cameco, CCJ, top dog, major contracts, and vertically integrated thanks to that Westinghouse deal with Brookfield. This one's not just a miner. It's a full-cycle player. Kazatomprom, Next Gen Energy, Denison Mines, smaller or state-backed, but heavily leveraged to rising prices. URA-ETF, Sprott Uranium Trust, UUCUU, easy ways to ride the whole sector. And don't sleep on the enrichment side. Companies like Orano, Urenco, and U.S. upstarts could boom if Western governments throw money at non-Russian fuel supply chains. Remember, when a market flips from a buyer's market to a seller's market, everything changes. Contracts get renegotiated, margins expand, miners get pricing power. Uranium's not just back, it's becoming strategic. And when something becomes a national security issue, that's when the government money and the investor money really starts flowing. So you've got a global nuclear build-out ramping and a fuel supply chain that's barely ready. That, my friends, is what we call a setup. Coming up next, we shift gears and look at the other half of this story, the grid. Because you can build all the reactors you want, but if you can't move the power, it's game over. Let's get into transmission build-out and grid modernization, aka the billion-dollar bottleneck. All right, let's keep the momentum going. Now we're stepping into the part of the story that's not as flashy as uranium prices or nuclear reactors, but might just be more important. Because what good is generating power, nuclear, solar, or AI-fueled magic, if you've got no way to deliver it? Let's talk grid infrastructure, aka the billion-dollar bottleneck that's about to explode with opportunity. Real talk. When was the last time you thought about power lines? Me neither. Until I realized this, the grid is like the internet of electricity. You don't notice it until it crashes. And guess what? Our global grids? They're ancient. Over 40% of transmission lines in advanced economies are 20-plus years old and nearing retirement age. Not good. Now mix in an energy mix that's shifting fast, with more renewables, more electrification, and a sudden spike in data center demand. And boom, you've got a grid that's totally overwhelmed. The fix? A massive build-out. We're talking 80 million kilometers of new or replaced lines by 2050. That's not an upgrade. That's a total rewrite. Let's zoom in on the U.S. for a sec. You've got over 2,600 gigawatts of energy projects, mostly solar, wind, and battery, stuck in interconnection queues. That's more than double the entire U.S. power plant fleet. Why? Because connecting to the grid is like trying to get Taylor Swift tickets during a pre-sale glitch. Delays, studies, lawsuits, repeat. Permitting a single transmission line can take 10-plus years. Just ask the folks behind the Trans-West Express, a 700-mile HVDC line that finally broke ground after a decade of red tape. Even FERC, the federal regulator, had to step in with reform rules in 2023. But it's going to take time to see results. And don't get me started on local opposition. Everyone wants clean energy, but nobody wants the power line in their backyard. Classic NIMBY behavior. Here's the hard truth. If we don't double transmission investment by 2030, a lot of those shiny wind and solar projects, They're going to sit there, unused, stranded assets. Like the Brookfield report said, there is no transition without transmission. And it's not just about renewables anymore. The data center boom and the AI craze that's fueling it is adding constant concentrated demand in places the grid can't handle. Northern Virginia, already overwhelmed. Oregon, same. Ireland even paused new data center connections. If the grid doesn't catch up, we're going to see delays in clean energy rollout, higher electricity prices, and in worst-case scenarios, blackouts. Yeah, not great. So what's being done? Utilities and governments are finally waking up. There's serious capital flowing into grid hardening, HVDC lines, automation, and resilience tech. That means new substations, stronger transmission towers, smart grids powered by AI, and even underground lines in wildfire-prone areas. And guess what? Companies like ABB, Schneider Electric, Eaton, and Quanta Services are crushing it. ABB's electrification segment record $9.8 billion in orders in Q2 2025, thanks to utilities beefing up grids for AI and renewables. Quanta Services, their project backlog hit $35.8 billion. That's not hype, that's booked business. And if you want a clean way to play the grid theme, check out the First Trust Smart Grid ETF, GRID, up approximately 60% over the last 5 years. Bottom line, grid modernization is no longer optional. It's where the real infrastructure money is going. Let's take a quick tour. China, leading the pack. Tens of thousands of kilometers of ultra-high voltage lines built in just the last decade. Central planning equals speed. Europe, playing catch-up but stepping on the gas. Projects like the Celtic Interconnector and North Sea offshore wind hubs are pushing the envelope. The EU's now streamlining cross-border, permitting hallelujah. United States, making progress, but slowly. The Infrastructure Act put over $10 billion into transmission, and now there's talk of giving the feds more siting authority to break state-by-state gridlock. Fingers crossed. The stakes, huge. A Princeton study says if the U.S. doesn't double its grid build-out rate, we could miss half of our 2035 emissions targets. Let that sink in. Bottom line, everyone's talking about the shiny stuff. EVs, AI, nuclear, green hydrogen. But here's the truth. None of it works without the grid. It's the hidden backbone of the energy transition, and it's where some of the smartest infrastructure investors are quietly positioning. Engineering firms, cable manufacturers, grid tech players, they're not flashy, but they're essential, and they're already cashing in. Coming up next, we're diving headfirst into the hottest narrative on Wall Street right now, AI's power demand. Is it overhyped, underrated, or the excuse governments needed to finally build serious energy infrastructure? Let's separate the hype from the heat. Up next. All right, here we go. Time to tackle the buzzword everyone's throwing around like it prints money. AI. More specifically, AI is going to break the grid. But is it though? Let's break it down stock whisperer style. Straight talk, no hype fluff. So let me ask you something. Have you seen those viral headlines? AI will outgrow global power supply. Data centers draining the grid. Your ChatGPT prompt might be burning a hole in the ozone. Yeah, drama. Now, don't get me wrong, AI is definitely power hungry. All those GPUs training massive models, they're not running on fairy dust. But the reality? It's a lot more nuanced than the doomsday crowd wants you to believe. Let's start with some facts. In 2024, data centers globally used around 415 terawatt hours. That's about 1.5% of all electricity. Not small, not massive. Fast forward to 2030, the IEA says that number could hit 945 terawatt hours, more than double. AI-related workloads are fueling most of that. Sounds wild, right? But even then, you're looking at just under 3% of global electricity. In other words, not the end of the grid, not even close. For comparison, Electric vehicles are expected to eat up way more power by 2030, but you don't see anyone saying your Tesla's gonna fry the grid. Here's the real twist. AI's power demand isn't scary because of the size. It's scary because of where and how it hits. It's concentrated and it's constant. Take Northern Virginia, the data center capital of the world. Data centers there used 26% of the state's electricity in 2023. That's not a typo. Over a quarter of Virginia's juice is going straight into servers. Other hotspots? Iowa. 11% of power demand is data centers. North Dakota, 15%. Oregon, 11%. Dublin, Ireland actually froze new data center connections because the grid couldn't handle it. These aren't global problems. They're local choke points. AI data centers run 24/7. They don't take weekends off. That's like adding a brand new city to the grid. Overnight. Now, before we all start panic building coal plants, here's the other side of the story. The data center industry? It's not dumb. These guys know power is their #1 operating cost, and they're investing like crazy in efficiency. Better cooling systems, more efficient chips, AI managing AI workloads. Yes, it's that meta. Liquid cooling for those power-dense AI clusters. Back in the 2010s, even as cloud computing exploded, total data center energy demand stayed flat thanks to gains like that. But here's the catch. AI changes the math. AI chips use 2 to 4 times more power than traditional CPUs, and cooling these monsters is a job in itself. So, yeah, efficiency helps, but demand is still rising fast. Here's the part most people miss. All this AI growth, it's actually fueling investment in clean energy. The Googles and Microsofts of the world are out here signing long-term PPAs with wind farms, solar projects, even nuclear startups. Yep, tech giants are literally resurrecting retired nuclear plants just to power their data centers. Shout out to 3 Mile Island Unit 2, back from the dead. There's even a U.S. government-backed $80 billion plan to build new nuclear reactors to meet AI-driven power needs. That's not speculation. That's already in motion. So instead of AI killing the grid, it's more like AI justified the investment we've been avoiding for 30 years. Let's be real. AI isn't going to consume all the world's power. It will add meaningful demand. But it's already pushing utilities, governments, and tech companies to think long-term and invest in real infrastructure. And from an investor perspective, that's where the gold is. We're talking grid upgrades, reliable baseload power, aka nuclear, data center energy management, clean power procurement tech, cooling infrastructure, AI-powered grid optimization. In short, AI's not just using power, it's reshaping the power investment landscape. And that's where the smart money is heading. Coming up next, we'll tie it all together and break down who stands to win from all of this. You want ticker symbols, ETF plays, sector leaders? I got you. Let's get into the key players and investment angles, coming up next. Let's go. Now that we've covered nuclear, the uranium fuel squeeze, the grid build-out, and AI's energy appetite, it's time for the part you've been waiting for. Who's getting paid? Let's talk key players. The companies, the tickers, the ETFs, the names you want to keep on your radar as this energy megashift plays out. All right, let's break this into buckets. Because this isn't a one-play story. This is multi-sector, multi-decade, and multi-bagger if you pick the right horses. Let's start with the folks who dig up the good stuff. Because no uranium, no fission, no electricity, no AI memes. Tragic. Top dogs here. Cameco, CCJ, the king of the hill. Massive production, long-term contracts, and oh yeah, joint owner of Westinghouse now, so they're not just mining, they're moving into full-cycle nuclear dominance. When uranium prices move, this stock rips. Kazatomprom, the world's biggest producer based in Kazakhstan. Bit trickier geopolitically, but massive scale. Next-gen energy, Denison Mines, junior players with high-grade projects in Canada. More speculative, more upside, but you gotta watch project timelines. Want diversified exposure? URA ETF holds a basket of uranium names. Sprott Physical Uranium Trust, UU/CUU, holds actual uranium. You're not buying a company, you're buying the commodity in a box, and here's the wild card. The real supply crunch hits post-2030. So companies with projects coming online in the next 5 to 7 years? That's the sweet spot. Okay, so who's running these reactors? And who's building the next generation? Constellation Energy, CEG. 21 gigawatts of nuclear capacity in the U.S., getting production tax credits up to $15 per megawatt hour from the Inflation Reduction Act. They're even offering 24/7 carbon-free power deals to corporate buyers. Nuclear as a service? Big potential. NuScale Power, SMR. First SMR designed to get U.S. approval. Backed by Fluor, FLR, who owns a majority stake. Still pre-revenue, so high risk. But if they break ground in Idaho in the next couple years, could fly. TerraPower, X-Energy. Not publicly traded, but keep your eyes on the ecosystem. TerraPower's backed by Bill Gates. If they succeed, expect knock-on effects across the supply chain. Rolls-Royce Holdings, RRL. Yep, the jet engine guys. Their SMR division is targeting early 2030s deployment in the UK. If it works, opens up massive export potential across Europe and Asia. ETF angle, VanEck Nuclear Energy ETF, NLR, and URA also hold some of these names. You know the saying, during a gold rush, sell shovels. This is the power grid gold rush, and these companies are selling the gear, laying the lines, and cashing the checks. Quanta Services, PWR, transmission construction beast, $39 billion backlog and climbing. Building the actual highways that deliver power to your home and your GPU-ABBLT. ABB, grid automation, substations, transformers, HVDC tech. Their electrification orders hit record highs, thanks to AI, renewables, and grid upgrades. Schneider Electric, SBGSY, and Eaton, ETN. These two are crushing it in smart grid tech, switchgear, EV charging infra, and energy management software. They're basically selling the brains and the hardware behind modern power systems. Prysmian Group, PRYMY, leading supplier of high-voltage cable, deep in subsea and interconnector projects, key for offshore wind and international grid links. ETF play? First, Trust Smart Grid Infrastructure ETF, GRID, a clean, diversified way to own the whole theme. Now here's where the AI boom meets the energy world directly. AES Corp, AES, Duke Energy, DUK. These utilities are doing dedicated power deals with big tech, renewables, and even nuclear-backed PPAs for hyperscale campuses. Westinghouse and GE Hitachi, leading the way in nuclear tech for data centers. GE Hitachi's BWRX-300 SMR is getting serious attention in Ontario and Poland. Schneider, Vertiv, VRT, major suppliers of data center power infrastructure. Think, uninterruptible power supplies, power distribution, high-efficiency cooling, and with AI density rising, demand for their gear is exploding. Equinix, EQIX, and Digital Realty, DLR, data center REITs investing heavily in energy efficiency, backup systems, and long-term clean power deals. So, who wins? You're not looking at one trade here. This is a multi-layered transformation across commodities, uranium, infrastructure, grids, transmission, utilities, and clean energy. Tech plus energy convergence. Some of these names will deliver steady cash flow, like Constellation or Quanta. Others could be moonshots, like NuScale or NextGen. And the smart ETF plays give you broad exposure if you don't want to pick individual names. But here's the secret sauce. Follow the money. Where government policy and corporate capex are aligned, that's where alpha lives. And right now, that money is flowing into nuclear grid modernization and powering AI. Up next, we'll close it out with the big picture, the short, medium, and long-term outlook for these themes, and how to position accordingly. All right, let's bring it home. We've covered the what, the why, and the who. Now it's time to zoom out and look at the when. Because timing matters. Whether you're looking for quick swing trades, strategic entries, or long-term compounders, you gotta know how this plays out over time. So let's talk outlook. Short, medium, and long-term. Let's break it down by timeline. Because some of these plays are heating up right now, while others are slow-burn monsters that'll mature over the next 5 to 10 years. Short-term, 6 to 12 months. Policy pops, supply risks, and earnings momentum. So what's hot right now? Cameco, CCJ, is already riding high off uranium's rally. And with spot prices above $80 per pound, you better believe utilities are locking in long-term contracts. Cameco's earnings over the next few quarters will show how much pricing power they've regained. Watch that realized price per pound. Quanta Services, PWR, has record backlog, and investors want to see it convert to revenue. If margins expand and project timelines hold, this thing's got more runway. ABB, Schneider, and Eaton, all three crushed order books in 2025. If Q1 2026 numbers show continued growth from grid automation and AI-driven demand, these names could break out. Risks: any disruption to uranium supply from geopolitics, Kazakhstan, Russia, Niger, or production hiccups could send prices vertical overnight. SMR timelines slipping or licensing delays could spook speculative names like NuScale SMR. Grid companies with labor or permitting issues might face margin compression if projects get bogged down. Also, keep an eye on new SMR permits coming from the NRC, potential M&A in the grid space. Don't be shocked if a conglomerate makes a play for a grid builder or cable manufacturer. Medium term, 2026 to 2030. Execution mode. Who delivers? Who fizzles? This is the make or break window. This is when the first SMRs, like Darlington's BWRX 300 or TerraPower's Natrium, need to get built, not just talked about, delivered. The U.S. transmission grid finally starts to accelerate, thanks to permitting reform, Farsi policy changes, and state-level pressure. AI-driven demand really starts hitting local grids, and we see if the utilities kept up. Winners in this window? Grid construction firms with locked-in contracts like Quanta, Mastech, and Prysmian. Nuclear players that actually build something: GE Hitachi, Rolls-Royce SMR, and X-Energy could move from hype to revenue. Uranium producers with new supply online by late 2020s, especially as the market starts tightening. We're also likely to see AI power demand doubling from today's levels. More corporate buyers signing nuclear PPAs, consolidation in the SMR space. Some startups won't make it. Others might get bought out by major players looking to scale. This is the harvest period for investments you're making today. That's why the smart capital is positioning now, not in 2028. Long term, 2035 and beyond. The age of electricity. Now we're talking structural change. By 2035, this is where we could be. Nuclear output doubled globally, with SMRs deployed across industrial parks, hydrogen hubs, and yes, even AI campuses. Massive build-out of HVDC supergrids, connecting regions, nations, even continents, fully digitized grids, managed by AI in real time, optimizing load across millions of distributed resources, data center power demand plateauing, or surging again if next-gen AI, or the metaverse, or whatever's next, goes mainstream, and yeah, fusion might show up. Maybe, but we're not betting the house on that just yet. The real play here is electrification as a lifestyle. Everything, from transport to heating to industry, runs on electrons. So who wins? Utilities that leaned in early, upgraded grids, locked in clean generation, and adapted their business model. Engineering and tech firms that became essential infrastructure providers. Investors who understood this wasn't a hype cycle. It was a structural transformation. Look, the story we just walked through, it's not just about uranium or grid wires or AI servers. It's about the rewiring of the global economy. We're entering an age where reliable, clean, always-on electricity isn't just important. It's a competitive advantage. Nuclear is back. The grid is finally getting attention. And AI, it's forcing everyone to build like it's the 1950s again, only smarter. So what does that mean for you? Find the companies solving the bottlenecks. Own the suppliers, the builders, the enablers. Don't get distracted by hype. Follow the infrastructure, because at the end of the day, one thing's clear. You can't code, mine, or innovate without power. And the companies delivering that power, that's where the real growth and the real money is. All right, fam, that wraps it. If you found this breakdown helpful, you know what to do. Like, share, subscribe, and tag someone in the comments who still thinks nuclear's a thing of the past. Spoiler alert, it's the future. Catch you in the next one.